There are usually two schools of thought about which ETF should be at the cornerstone of any portfolio. Warren Buffett, the Oracle of Omaha, and considered one of the greatest investors of our time, he recommends that individual investors use the S&P 500 for their primary investment. While John Bogle, the founder of Vanguard and the creator of index investing, favored the Total Market Fund as the pillar of his three-fund portfolio. Now, don't get me wrong, these two were not at odds with each other. In fact, they were huge admirers of each other. But a question I often hear, and one I see debated on message boards frequently, is whether you should use a low-cost ETF for the S&P 500, like Vanguard's VOO, or the Total Market ETF, like Vanguard's VTI. I'm going to break down the significant differences and similarities to help you understand the distinctions of each. I'll also offer some other ETF options that may work better for your situation. Let's first look at the basic differences. VOO, the ETF for the S&P 500, is a basket of most of the largest 500 U.S. companies. VTI, Vanguard's ETF for the Total Market Fund, aims to have every publicly traded U.S. company in it. Currently, it has slightly over 3,700 companies. Now, the first thing I want to look at is the top 10 holdings. Notice there is very little difference here. Both of these ETFs are what's called market cap weighted. That just means that the biggest companies get the majority of your investment. Currently, Microsoft is the largest company in the U.S. as I record this video, and therefore it gets the biggest percentage of your investment. Think of it this way: if you invested $100 into VOO, $6.96 would go into Microsoft, $6.30 would go into Apple, and so on. Notice the top 10 holdings are identical. For VOO, the top 10 holdings comprise of 34.07% of the total investment. And for VTI, the top 10 holdings make up 29.69% of the total investment. So there's just a subtle difference here. But because they are both market cap weighted and most of the money goes to the biggest 500 companies, the overlap between the two funds by how the money is invested is actually 87%. Let me take a quick moment to say I'd really appreciate it if you hit the like button and leave a comment below after the video. Thank you. Now, even though VTI can be thought of as being more diversified, that perceived difference isn't as much as many people think. In fact, it's not like the S&P 500 only has large cap companies in it. Here's the breakdown from Vanguard. As you can see, both have approximately 4% in medium to large size companies and approximately 13% in medium-sized companies. VTI has approximately 3% more in medium to small-size companies and approximately 7% more in small-size companies. That 3 and 7% equates to an additional 10% in the large companies for VOO. Now, if you are wondering what's the definition of these various sizes, here's the breakdown. Companies classified as small cap have a market capitalization at or below $7.619 billion, and medium to small has a value between $7.618 billion and $16.39 billion. Now, anytime we are investing and choosing funds, expenses are important. But both of these funds have an expense ratio of just 0.03%, so no difference there. This means that even if you had $1 million portfolio, you would only pay $300 in expenses each year. Compare this to a mutual fund where expenses could range between 0.5% and 1% or more, and you'd be paying $5,000 to $10,000 or more expenses per year. Now, what about the dividends? VOO currently has a dividend yield of 1.36%, and VTI has a yield of 1.34%. Again, a very subtle difference, but not enough to sway the decision one way over the other. You might think that VTI, because it has more companies and more diversified, would be less volatile, but that would be wrong. Since it includes more mid-sized and small companies, which tend to be more volatile and more prone to bankruptcy, VTI is slightly more volatile. It's not significant though. Using Portfolio Visualizer for the period starting January of 2015 and running through the end of 2023, VTI has a standard deviation of 16.3%, and VOO was 15.8%. Standard deviation is just a way to measure how much a price of an investment fluctuates or moves up and down over time. Again, there's really very little difference here. So what really matters is performance. Let's take a look at that. Again, for the same period, the S&P 500 had an annualized return of 11.7%, and VTI had an annualized return of 11.2%. In recent years, the S&P 500 has been outperforming the total market fund slightly because large technology companies have been outperforming the overall market, and the S&P 500 has around 36% of its assets in technology, and VTI has around 33% of its assets in technology. Also, in recent years where the market has performed poorly, like 2022, VOO was down 18.19% and VTI was down 19.51%. Now, past performance doesn't guarantee that VOO will continue to outperform VTI, but it has been recently. But this difference is still not that significant. Let's look at $100,000 invested into VOO over that 10-year period growing at 11.7%. It would have grown into $302,365. The same investment in VTI growing at 11.2% would have grown into $289,099. So about $13,000 difference over 10 years on a $100,000 investment. However, as I mentioned, no one really knows for sure which one will outperform over the next 10 years. Okay, so which one should you choose? First, if you are investing in a 401k, you are limited in your choices, and there's a greater chance you have access to something resembling the S&P 500 than you would the total market fund. In this case, just pick the fund with the lowest expense ratio that is the closest thing to either of these and feel great about it. Most likely, you'll have something like the S&P 500. Now, for an IRA or personal brokerage account at a discount broker like Fidelity, Schwab, Vanguard, you have a choice. You really can't go wrong either way. Some people like the idea of being a bit more diversified, so they prefer the total market fund. Others prefer the S&P 500. As you can see from the data that we have covered, there's truly very little difference. If you've been watching my videos, you know I always recommend the S&P 500. There's just so much good data on it and very good historical calculators verifying its performance. However, I acknowledge that the total market fund is an equally good choice when considering no one really knows which one might be better over the next 10 years or 20 years. They are both great core holdings in any portfolio. For example, look at the rates of return for the S&P 500 with the dividends it pays for the periods ending in 2023. In the past 5 years, it's averaged 15.75%. In the past 10 years, it averaged 12.07. 20 years, 9.69. 30 years, 10.16. And the last 40 years, 11.37. Now, there are other ETFs that are essentially identical to VOO, such as IVV, SPY, and the SPLG is one I recommend a lot. The SPLG is a great choice for many because it has a lower price per share. It makes very little difference which one of these you buy. As for similar ETFs to VTI, you could use Schwab's SCHB or ITOT. which is nearly identical in its makeup. By the way, you don't need an account at Vanguard to buy VOO or VTI. They are both available at popular discount brokers like Fidelity and Schwab, and all of the ETFs I've mentioned here have very low expense ratios. One other thought to leave you with. I would stick with ETFs over mutual funds that are similar to VOO or VTI whenever possible. Mutual funds tend to have higher fees due to being actively managed, and they don't trade throughout the day like an ETF. With a mutual fund, regardless of when you place the order to buy, the price is calculated at the end of the day. Therefore, mutual fund investors really never know for sure what price they're going to be paying at the end of the day. Also, always be careful to stay away from any mutual funds with loaded fees or early redemption fees. And finally, for investments that are not held in a retirement account, ETFs tend to be more tax efficient. Sales within a mutual fund may trigger capital gains for shareholders, even for those who have not sold any of their own shares. This can happen because though these are both broad indexes, there are slight adjustments to the stocks they hold throughout the year. Both have a turnover rate of approximately 2.2%, so some of the stocks are removed each year and replaced with others. I hope you hit the like button, and please leave some comments below. I appreciate you watching, and I hope it's been helpful.